Let's kick this week off, Joe. You're going to get data, which is front and center. And the rotation trade is in full effect. Take a look at market performance over 1 week. We're going to show you sectors to give you an exact picture of what's been happening within this market. Materials up 4%, financials up 3%, industrials up 1.5%. Cyclical plays. What's down? The bottom of the list, communication services and technology. So that's how we begin this week. Deutsche Bank says tech saw its first back-to-back weekly outflows since June. We have this rotation trade going to continue?
Right place to start the conversation.
Thank you.
I think this is going to continue as we go into 2026. I think from a bigger picture perspective, thinking about the broadening out and the opportunity outside of just the Mag 7 and the AI adjacent technology names is real. I think you carry that into 2026. There has been a meaningful rotation. It started with the momentum factor kind of rolling over, and now it's really more isolated to technology and AI itself. I think in the near term, there is going to be a little bit of a return to some of the Mag 7 names, some of the technology names, just in terms of the performance differential between the 493 and the 7. It has gotten pretty wide. I think this morning we had a meaningful flush lower. I wouldn't be surprised to see a little bit this week if you see the Mag 7 come back, if you see some of these technology names come back and narrow that price differential. But bigger picture, I like where you're going with that. I think the rotation's real.
You're going to get always, nibbling and dip buying in that group, but the so-called run it hot trade, that's what remains in focus as people prep for 26. Is that something to run with for the foreseeable future?
I think so, and I think there's a couple of things here. Number one, we still have this transmission of lower interest rates, regardless of whether you think they're going to do 1 or 3, depending on what happens in May of 26 with the Fed chair. I think that you get that as a tailwind. The other thing is, Scott, we saw the Fed increase their expectations for economic growth next year, and that run it hot trade is based on the fact that you are anticipating an inflection higher and a reacceleration in everything from manufacturing and construction to consumer spending, and this liquidity infusion that we're due in April and May around tax time. All of these things really are supportive of the fact that if you're looking at just the fundamentals and why equities go up over time, it's earnings growth, and earnings growth is expected to be strong up and down the U.S. cap next year. And so to Joe's point, we may see, this delta between the Mag 7 and the rest of the 493 narrow at certain points. But I think in terms of where we are, we're seeing a channel where earnings growth is going up and to the right, and the bottom part of that channel is continuing to rise as a result of the more attractive valuations and the anticipated earnings growth next year on economic tailwind.
Some are wondering, Weiss, whether the casualty of all this, if you want to say that, will be new highs for the S&P. Like, you got your new high. And then you had a Fed meeting, and then the run it hot trade seems to be the outcome of what happened there. Wolf says so much for a return to new highs. Was starting to look like new highs before year end were inevitable. It's now becoming evident that AI euphoria is starting to fade into the end of the year. We think there's a good chance that trend persists into Q1, which likely does not bode well for tech. We don't necessarily have to have a conversation about tech specifically here, but the other idea, run it hot, buy what's hot. Shan hit it. It's consumer discretionary. Hits a new high today for the first time since September. Restaurants, retail, Marriott got an upgrade. Financials have hit a new record high. Those are the kind of stocks that are getting a lot of ink today.
They are. As the market looks for laggards, I've been embedded in this technology trade for so long, and it's always served me well with this V-shaped recovery off to new highs, and that's not really happening. And when you take a look at what the Amazons and the Metas have done in the year, they've really lagged. So new money's looking for places to go that's unloved, and that's consumer discretionary. I personally wouldn't stay in that trade too long because I don't think the consumer's bifurcated, right? There's the real, those that don't worry about the economy every day that keep spending. So that's probably good for luxury, except on the margin. Some that reach for that class won't be reaching for it anymore. And then there's, those that are really worrying about their jobs as you get more and more layoff announcements. So I do think that the bull market will continue. I think now, we're just not. I'd be surprised if we saw a strong rally into year-end.
Well, I mean, if you look at some like I said, the Marriott upgrade today. Now, that's in part of thinking about the higher end.
Yep.
Hilton's up today.
Yep.
Royal Caribbean is up today. Some of the restaurants are up today.
Is up, yep.
So, like, again, the recurring theme of the demise of the consumer. And you can't just tell me that it's the high end that's supporting the Shake Shacks or the Brinkers.
No, I don't think it is. But I also believe that the costs at the supermarkets, which have gone up, and you've got less of a spread now between eating out in the Brinkers and buying foods, make your own meals. And I don't think it's dead, right? We've got a very resilient consumer that believes in the country as they should and believes that things will work out, and they will, ultimately. But I think next year you've got to be very careful where you go. And I do believe we're going to see more AI affecting more jobs, and that's going to drive the market, actually, because it's going to increase productivity while lowering labor costs. So I think we're okay, but it's picking your spots. I think there are plenty of other spots to pick aside from consumer. That trade's good for now.
I got you. The other thing, by the way, is obviously discretionary is being skewed somewhat today by Tesla's move, which is up near 4%. So anytime you get a big move in either Tesla or Amazon, you're going to see it show up in the discretionary sector. Tesla's up a lot today on news that it's testing driverless robo-taxis in Austin. It is a significant advancement for what they're trying to do. Not surprisingly, Uber and Lyft, you can show those because they're lower. You personally sold Uber last week. By the way, we have a special interview coming up. Ron Barron is going to be on ETF Edge today, along with his son, Michael. That's a big deal. One can only presume that we'll ask him about what's happening with Tesla. So what about this? I mean, it's, you see Tesla go up, you see Uber go down. This is the way it works when you're talking about robo-taxis and autonomous and the efforts that these companies are trying to compete in.
Yeah, there's the conflict between trading and investing, maintaining two different perspectives on where you think something ultimately can go and reshaping your risk accordingly. Long term, I believe in the fundamental story for Uber. It is in the JOTI ETF, so I'm covered there. Near term, I do not like the way the stock continues to kind of bump its head against the ceiling, somewhere between 90 and 95, and fall back and continually test this $80 level. I think at that $80 level, which is a critical swing area, previous resistance, it breaks through there, you're going to see further deterioration. I think that's really more decision-oriented about trading than anything else. And I also think right now where we are collectively in the market, I think trading decisions are kind of dominating more than investing decisions.
Well, I don't know. I mean, if you look at the areas that are working, I'm not sure if it's necessarily, Shan, trying to trade the market. I think financials are hitting a record high because for all the reasons I said, the run it hot economy, yield curve's been steepening.
I think there's more to it. I'm sorry. I don't mean to interrupt your thoughts.
Well, I'm not saying there's not more to it.
There is more to it. From a portfolio manager's standpoint, you're always looking strategically at various factors and looking at risk. I also think a lot of this story, and we're getting to the same place because we both are identifying that these are the places you want to be in the market right now, but there's something about low beta versus high beta. And at the beginning of the year, everything was about high beta. Now the market seems like it wants to gravitate towards lower beta. Look at healthcare, Scott. Healthcare is the leading sector today. It's been the leading sector in the quarter. Why? Because it checks the box on beta, it checks the box on being defensive in a certain sense, and it checks the box on valuation. And this market, as we moved into the fall, was concerned about valuation. So I think it's collectively all of it. And I think portfolio managers are really driving right now in the near term this move towards the 493.